All right, looks like we're live. So, welcome to another episode of Trading Homework. Today is February 15th, 2021. And the market's closed today due to President's Day. So I thought this would be a pretty good opportunity to do a little bit of a longer episode. And we'll zoom out and look at kind of a big picture, macro. And we'll look at individual names, and if people show up in the chat and they want to take a dive into anything, then we'll do that. So with that, I brought a beer with me, so I'm just going to have one afternoon beverage here. This is a Lagunitas Hazy Wonder IPA, and I'll just be enjoying this while we relax and go over charts, and we'll do the FinViz screener too. So if you're watching this on replay, this may be a little slower broadcast than normal. So if it gets slow, feel free to speed up the replay, and you can slow it down for the good parts. So yesterday I had STFR, sell the fucking rip trader, STFR trader on Chris. And one of the things that we saw, that we ended that show on, was we were looking at the dollar. And I'm going to bring up the chart of TLT here because we switched over to that because it's pretty liquid options. And so I wanted to go into this a little bit. So that's not exactly how I wanted to have the chart appear, but that's okay. This will work. So this is a weekly chart of TLT, and I mean this has just been rolling over for quite some time. It's kind of an ugly chart, but what we talked about was after the stimulus happened back in 2020 in March, it really tanked TLT. And because the volatility has been so wide here, that we may be looking at, with another stimulus coming up, we may be looking at an opportunity where getting some out-of-the-money strangles on TLT could pay off. If you leg out, it could pay off on both sides. So that's something I wanted to look at. I'll try and pay attention to the chat too. So if anybody pops in and wants to comment about what's going on, I'll try and pay attention to that better than I have in the past. So let's flip over to the options for TLT and kind of explore that a little bit, and then we can maybe get into the timing of the stimulus. I'm not exactly sure when we can expect that, although it seems like there's maybe a push now that the impeachment stuff is out of the way, that there may be a push for that to happen sooner than later. So I'm not sure what kind of timeline we can expect just yet, but you can see that TLT has weekly options. So that kind of gives us a lot of possibilities here. I think that next week is too soon to expect any kind of stimulus-based, other than people positioning ahead of time for it. But it may give us a feel, looking at next week, what the near-term options might look like as we get a little closer. So I do still want to take a look at that. If we were to do a strangle, we can see that it's 147 right now, TLT. And I want to look at the ATR on it, so that'll give us a feel for the range. And so down here, you can see that the 14-period weekly ATR is about 4 points. So let's just start with that and go 4 points on either side of 147. Just to kind of get this started. And again, this is with 1 week to go. I don't think we're going to see a stimulus this week, but I want to just start with this to get a feel for what we might be able to expect. Oh, hang on. Go into the strategy builder here. Let's look at, I mean, these look really cheap. It looks like for it to move, yeah, these look really cheap. So 147 and 151, really cheap on both sides. So what I'm looking at right now is in the interactive brokers paper trading account is what we're looking at. I don't do any paper trading in the paper trading account, but I do open it up when the market's closed to do these trading homeworks because their options tools are really great, and so it's fun to explore trading ideas in the options combo builder. So that's what we're looking at right now, in case you're curious. The charts, the chart back here is from stockcharts.com. All right, so this one, let's age it for a couple of days. If we were to hold this for a couple of days, we could lose some money here. It's got a low probability of having a profit. And if it goes nowhere, we're looking at losing 25 bucks on what do we put in, the minimum investment, $30. I mean, in other words, it's basically worthless in just 2 or 3 days if TLT doesn't go anywhere. That's the nature of short-term options. They evaporate quickly. And so the point, though, about that is the closer you can time it, the more profit you can expect to make. So having a good expectation about when the stimulus will happen can give you an advantage. And if you're not sure, you have to be looking further out on time frame, and then the options moves aren't going to be so dramatic. Like in this case, we're looking at $31 per strangle, and it could pay off. We're looking at if there's a move 5% either way. The payoff is $10 for every $1 you put down. Well, I guess the payoff is $9 for every $1 you put down, but you'd have 10 times your money. That's pretty big. However, if you're looking at this on in 2 days, it gets so much even cheaper. So again, if we can time it down to the day, that would be ideal. So I haven't done too much timetable research on this. I will say that Meet Kevin has a pretty good video. He's a YouTuber. He has a pretty good video about the stimulus package. He follows it pretty well. He gives a numbers breakdown that I found to be pretty helpful. My one complaint about his video is it's full of ads. So be by your phone or your computer or whatever, so you can skip over the ads, or else you may find yourself stuck in an ad loop for a while. So that was kind of annoying. I was trying to watch that, not necessarily like actively at my phone, and that was frustrating. So hey Kevin, if you're seeing this, man, like you're really monetizing the crap out of those videos, and it's pretty annoying. All right. So now let's look a little further out. I mean, this strangle is kind of ridiculous, and probably if you're putting it on with less than a week to go, you may want to be using more like a daily ATR than a weekly ATR. I mean, this is just like really out of the money. It's, the profit probability here shows you 10%. It may even be less likely to happen than that. And the other thing that I'll mention is as you get closer to when the stimulus might actually drop, that the volatility premium in the options will be higher, and so it pushes the eventual profit down even from huge moves, because there's no news catalyst behind it. So you get that IV crush kind of situation. And if the premium gets too big, then what we may look at is trades that benefit from the time decay. All right, let's go out another week, and let's look at the same strikes. Actually, looks like they're missing a strike here. 147, I was looking at 143. Okay, that's fine. It doesn't have to be perfect. 47 to 151. Okay, so this one's a little bit screwy, but so in this case, because there's more time left, we're paying more, and it's suggesting that there's a higher probability that the price will have moved that same distance when there's 2 weeks to make the move. So this is probably more realistic for the distance of a weekly ATR if you have more than a week of time on the options position. But the profit probability is a lot lower. I mean, I don't know that this looks juicy enough for me. And it is open-ended, so if the move is substantial, it can make a lot, but I don't know. I don't know that I want to sit in this strangle for very long. So this will be something we'll have to keep an eye on. We'll revisit this, but and you may have a directional view too about TLT. Like if it were to continue lower, there's some pretty good ways to play that. So say we thought that TLT was going to be lower. I don't know, just like say it opens, and we thought it was going to close at the opens near the top end of the candle. We think it's going to close near the bottom end of the candle. What's a good way to play that? Well, let's look at a combo for that. So I flipped to the daily ATR because we're holding this position for only 4 days, theoretically, right? We could get into it Tuesday morning without overpaying, and then hold it until Friday. The daily ATR is probably a better one to use. So this is only $1.32. So let's come back in here and look at what that might look like on the put side. So we're going to do a bear put spread because we don't want to overpay for an option.
Data connection lost.
Oh no! Market data connection lost. A little loud. My internet winks in and out. Plus, it's super snowy right now. So hopefully my internet's still going. I'm gonna assume that it is. All right. So in this case, we bought at the money, and I don't know that I really like that. Let's push this just a little bit more out of the money. Let's put it right there. Okay, what does that look like? I'm not super excited about that one. Yeah, there's a little bit of a lag on that. My internet might have had a hiccup, so sorry about that. Let's look at last week, how much it was down. TLT was down only 1 point. It looks like the week before that was down 2 points. If it has a really big down week, like this week, this looks like it's about 3 points. So if we want to bet on a big week, then what I might look at doing would be to buy here, buy the 146 put, sell the 144 put. And again, the reason to cap it is because there's not a whole lot of time to move. So this one, it may be that the way to put this on is if the market moves up slightly, and then you can get it for cheap. So if you look, there are opportunities when the market goes up. The TLT market. So if it goes up, maybe you can put it on for a couple of points for cheap. I'm not too crazy about this one either. So in this case, you make it's got a risk reward here of almost four. So I mean, that to me is kind of interesting, but we're not talking about big amounts of money, and these are also not all that liquid. So Probably not worth spending too much time on this idea. All right. So let's keep moving now. I've been talking a lot about silver on here, but I haven't talked about uranium yet. So let's take a look at CCJ. Some of the folks I follow on Twitter, we're calling this one out. Look at uranium. There's a uranium ETF too, URA. And this is like a Stan Weinstein type of market turn going on here. And if you don't know him, he wrote a book, I think in the 80s. It was a really neat book. I haven't read it in many years, but this looks like the kind of thing that Stan Weinstein might be interested in. So we can look at the holdings for the uranium ETF. I already did that, and I found that the uranium ETF had a less liquid options market than CCJ. And one of the people I follow on Twitter, his name is USR Flyer, User Flyer or something like that. I'm not sure how he pronounces it. But anyway, he pointed out that the options for Cameco in Canada were even more liquid and maybe better than the US options for Cameco. In this video, I'm just going to be looking at the US options, but it might be something worth looking into. So it's pulled back from the high, but it's still kind of a nice breakout situation right here. As we zoom in, it's going to look maybe a little less exciting compared to some of the things that we've seen lately in the marijuana stocks and the blockchain stuff. But I mean, this is still like a really exciting looking opportunity to me. And so going back to a play on rising long-term interest rates and a more inflationary scenario, I think Cameco kind of plays into that. It fits my theme. And so I've talked a lot about running a long-term campaign in a stock. And this thing has come to life. And so this is the kind of thing that it may run for a year. If it does, then that presents a special kind of opportunity that you don't necessarily have with a lot of stocks. I hope my internet is not choppy on the stream. I hope it's just Interactive Brokers that's having issues. So, okay, here we go. Let's look at the CCJ options, because we have not looked at that yet on the show. So I'm trying to not go back and repeat myself on shows that I've done recently. There are so many interesting stocks we've already covered. Let's talk about a long-term campaign in CCJ. So I was looking at this recently, as recently as earlier today. If we think it's going to run a year, if we think it's going to run for multiple years, then so let's just put that as a hypothesis that this might run for a couple of years. And maybe we have a price target over a couple of years at somewhere between 80 and 100. I mean, and you don't have to limit it. I mean, these things can They just look at some of the big tech stocks that have been in long-term moves. Another one I could point out to you is Palladium. Like if we zoom out on Palladium and look at that, like this has run for years, and it's up many multiples. So this is the kind of thing that's possible. It looks to me like we're in this area right here. In uranium, it looks like this kind of a buy zone right here. And so to just kind of give a blueprint about what this might look like, only keep in mind palladium's a precious metal. Cameco is a stock, and as a stock, like it can have a little bit of a different price character to the move. So. Anyway, let's assume that something like this is possible. So if we have a price target of somewhere between 80 and 100 over a 2 or 3 year time span for Cameco, then what we can do is so that's going to be the basis for the campaign that I'm going to talk about now. If that's true, then we can afford to be very patient. And so, normally what I would do with the stock that's already moving is I do a few different kinds of options combos, but they're not really that long-term oriented. Probably the longest term oriented one that we've talked about a lot is the swoosh position. So let's talk about a swoosh position first. And then we'll go back and look at a longer term campaign and how you can do more with even less money if you have long-term strategic plan that you implement, and we'll talk about some of the tactics at various steps. And so first, I'm going to talk about the swoosh trade, which is an intermediate term position trading technique that I've developed. I talk about it on the show a lot. So Cameco is $16 a share right now. So if we were going to make a swoosh position on Cameco, let's just build one. So I'm looking at a 3 to 6 months out at the money call option. So here it is. We're looking at July 16. And we're going to try to get for somewhere between 25 and 30% of the price of the call we're buying. We're going to try and buy some short-dated protection that's about 10% out of the money. So let's flip over. We're going to also buy a put with about 3 weeks to go. And that'll put us right about somewhere in here, the 15 or the 14 and a half. And so the idea here is the put that I'm buying, I don't want it to get less than 2 weeks old. Because as we talked about earlier in the broadcast, when an option that's out of the money, this put we're buying is out of the money, and ideally the stock's going to be rising, which is going to make that put go even further out of the money. Most of the time decay happens in the final 2 weeks. And so if we roll it before then, we have money to roll. We don't have to add a whole lot to maintain kind of the same position. So we can keep rolling at the 15 strikes for not a whole lot of money, even if the stock rises higher. So the reason it's called a swoosh position is because when you look at it in the option simulator, it looks like a Nike swoosh. So there it is. And what you'll see is if we fast forward this, play it forward by about a week, you'll see that if the price doesn't go anywhere, we get some time decay. This mostly comes from the put. And so we'll essentially be looking at paying maybe $55 or so to roll that put to another put that's 3 weeks out. And what we're going to be paying overall for this position is $345 because it's $3.42 plus commission. It's the commission on two options. So this combo, we can expect that we're going to move along this dotted line. So if Cameco takes off, then we're on this line, and as it keeps going up, the delta of our in the money call gets higher and higher. Our put becomes almost worthless, and that's fine. That's the idea. In fact, at some point, it may not even be worth having at all. Or you can roll up the higher strikes on the put. It's kind of a dynamic thing that I'm managing on a situational basis. But if Cameco doubles from 16, that puts it at 32, right? And so here's what the picture looks like. And remember, we're not at our target. I mean, I think that Cameco probably can double inside this time period. I think maybe it can double within we'll say 2 or 3 months, maybe 4 months. And so what I'm going to show is a way that you can start off a campaign, a long-term campaign, even further out than this for even cheaper. You can get more for less money. So this is we would expect it to be. The call will be worth about $12 at that time. But the thing about that is it's now deep in the money call. So what I want to look at next is what if we buy some further out calls that are further out of the money. One of the characteristics about the swoosh trade that's so nice is the call we're buying that's at the money. It never really experiences much time decay. And the reason is because if the price of Cameco falls, it falls to 12. The protection that we bought allows us to roll our 16 call down to a 12 call and again buy another protective put. The reason we do that is because we want to keep our call with 3 to 6 months to go. We want to keep it at the money so that it's not experiencing a lot of time decay. The time decay is just coming from the put. That's the idea here. You still have to be right in the end that the stock does go up and experience a good price advance if you want to make money. Maybe if it fell to 12, we might just want to close it out and just say, well, the idea kind of fell apart. The upside that we thought was there isn't there. I mean, that's certainly an option that we would have, or a choice that we can make to avoid a pun there. So let's revisit this 30 because interestingly, well, let me clear these off. Since we've talked about the swoosh, we're going to come back to that. But what if we can inexpensively set it up so that we can have a swoosh later on down the road, but get it for even cheaper if we just planned ahead and there ahead of time? So in that case, take a look at this. If you remember the position we were just looking at cost $3 and we'll say about $3.50 for the option, or $350. But if you thought that the stock was going to quickly get to 30, what you can do is you can go to this January 2022, and instead of buying $300 worth or $350 worth of the at the money option plus the protection, what you can do instead is you can buy 2 or 3 of these for the same amount of money. These out of the money 30s that have about a year to go. And so what I like about this is we can get 2 or 3 times as much of them. And so by the time that the option does get to 30, let's take a look at what 3 of these might be worth. Or let's just call it 2. Let's call it 2 of them. If we want to be conservative. And keep in mind that, these are out of the money. They have a lot more time on them. So because they're further out on the calendar, they're going to be experiencing a lot less time decay. And so having the protection doesn't matter so much. And here's the reason why. Because it's so cheap what we got into in the first place. If the price went down and had experienced that drop we talked about, you might be able to get these options for a lot cheaper. And so you can essentially just incrementally build a position out here. And maybe for not a lot of money, if you wait and just buy it on down days. You can accumulate quite a lot of this. Like say it falls. If this 30 call falls by 40 cents because the price went down 5% on Cameco or something, then you can get even more of them. And so anyway, let's take a look at this in the performance profile. And at 100% move, if you say you had 2 of them, well, now you're looking at $1,400 position and with maybe a lot of time on it. So then what you can do is roll it once it becomes at the money, and after 100% move, it would be at the money. So for the same money, you could have a position that's bigger. You'd have more shares. You could convert it into a swoosh position. So the idea here would be to roll in on the calendar once it's at the money to where you're at that 3 to 6 month duration. Take the profits and use it to buy protection to convert it into a swoosh position. And you've got maybe twice as many shares as you would have otherwise had, because you've got 2 calls for every one that you would have had if you just bought it in the beginning as a swoosh position. So anyway, these are just some possibilities. So now we've talked about Cameco. That's kind of a neat emerging opportunity. To me, this looks a lot like the marijuana stocks did. I don't know, like 3 or 6 months ago. Let's just flip over to that real quick. And so about 6 months ago, similar kind of opportunity here with MJ around $12 to $15 range. All right. And by the way, I mean, my outlook on this is, even though there's quite a setback last week, I think that despite maybe some short-term downside, this is still probably something that can run for a while on MJ. It may not. Or I said last week there's a monthly chart. It may not keep running, but I mean, look at that volume. It's huge. A catalyst for why this might not keep running would be if the expectations that people had for the Biden-Harris administration on removing the prohibition of marijuana, if they get rid of or if they don't sort of engage with that campaign promise and make that happen fairly quickly, then I think you could see this upward stock movement on these kind of stall out and maybe make another base for a while. There's certainly a lot of promise in this area. So anyway, I was moving on. We're moving on from CCJ. So let's look at. I've got a watch list over here on another screen. And I want to talk about some things that we haven't talked about yet on the show. So open. I don't have a position in this yet. This is Open Door Technologies. I looked into it a little bit. It looks like maybe a Zillow kind of thing. IPO'd recently. It's ran up a lot, but it looks like it's kind of made a healthy base. And there's a great volume pattern here. Like, it's got periods where it's just like big up volume. On weeks where it's up quite a bit. So a pretty healthy looking price pattern. Looks like it could run for a while. So this would be another place where I'd be looking to put on a swoosh position, except for guess what? Open only has monthly options. So it's a lot tougher to do that. You can't just roll that protected put every week. You have to go further out on the calendar, both the call and the put. So you're looking at more like 9 months out for the call, and maybe like 3 weeks to 3 to 8 weeks on the protective put, and have that protective put be again 10% out of the money roughly. Other ways I've gotten around is by buying two puts and having them slightly further out of the money. But it's very situational. So I like open. Mostly from the chart. I think this is a great looking chart. I don't know a whole lot about their business other than I can tell you Zillow is up a lot. Let's look at Zillow. So Zillow had a great week last week. It's just been a stock that's been grinding higher since the lows in March. It kind of tanked along with everything else. Well, it didn't get hit too bad compared to a lot of things. It's now like a 10 bagger off the low. I wasn't buying Zillow at that time. It wasn't on my radar. I guess I didn't really foresee that housing just across the countryside was going to explode higher, and Zillow was there to facilitate a lot of that. I mean, I was really focused on the commercial real estate situation going on, which is super ugly. It's still kind of ugly. We look at REM. I mean, it's up, but I mean, it is taking a long time to make a recovery. And now it's at a price that it may find to be resistant around 34. However, you can't overuse technicals on REM. Instead, you have to focus on the business situation for the companies in it. And another thing about it is a lot of the mortgages in REM are their agency mortgages. So I think their top holding is AGNC. That's either number one or number two holding. The other one is NLE Capital Management, which also has a large allocation to agency mortgages. So you've got to look at the holdings in the various companies. It has a surprising amount of churn to me. I used to know what all the companies were in this thing 10 years ago. It's actually pretty different now. Like the top names are still the same, but the other names are rising and falling as the different regions in the country experience growth. So the other thing about it, I'll point out, is they're paying out big dividends because this is a real estate investment trust ETF. It pays big dividends, and so the price here at 34, it wasn't really 34 back here. It paid out so many dividends. It skews this chart in a way that this is a dividend adjusted chart. And so you've got to be really careful using the technicals on something like this. So during this crash right here, I was in there looking at all the different names and trying to pick the winners and the losers. I ended up just buying a whole bunch of the names, and then I figured, I guess I'd rather just have REM at this point. I sold them all in, I think, May, and converted those over into REM shares. And then I ended up selling them in the beginning of July, I think. Somewhere around in here. I kind of punched out of it all. And I ended up buying some more right here in this breakout, and then ended up selling it. Flipped right back out of it in August, and it's gone sideways ever since until this reopening breakout that happened. We had an echo boom, a second reopening rally. And we may be experiencing another one soon because of the testing guidance from the World Health Organization has changed, and that is now. Well, I'll just put it this way: we can expect to see fewer positive test cases. I don't really want to get into that too much here. I've already tweeted about it plenty. And that's old news now. So interest rates matter for this. One driver REM is going to have that's a positive driver for REM. Is the yield curve is going to probably continue to be steep. It's steep right now. The first thing we were looking at earlier in the broadcast was TLT. As TLT falls, the interest rate on the long bond goes up. You know that short rates are staying the same. So the steepness of the yield curve, when it's really steep, that does well for banks because banks borrow short and lend long. They borrow at short-term interest rates and they lend at long-term interest rates. It used to be that they borrowed from the depositors in the bank back when banking was very regional and separated, and it seems like that's kind of a business model for banks that due to deregulation, I guess, is it may be necessity too. It doesn't work that way so much anymore. The borrowing short and lending long thing, however, does. It's just who they borrow from isn't so much the depositors in the bank anymore. So I want to look at XLF next because we can expect with the yield curve being so wide. This thing is doing great. Had you got into XLF instead of REM, well, I mean, it came off such extreme lows, but XLF really kind of been roaring back. And I have to say, I was pretty negative about banks back in October and November. And this kind of like rolling over looking chart here. It threw me off. And this big gap up and run here has just been it's been a hell of a run for banks. Wells Fargo was one that I was shorting. I mean, I was just wrong about that. And when you're wrong, you lose money. That's okay. It's fine to be wrong. It's just you can't be wrong about everything. You stay in business. So you also can't be really wrong and stay in business. So the name of the game is keep your bets reasonably sized and do what you need to stay in business. For you GameStop traders out there, that's just buying and holding on that thing, man. That's not the way I I don't think that's the way. I don't think that's the way. So anyway, Wells Fargo. If banks are in a short squeeze right now, this one is probably going to be one of the big runners. Another one. Let's look at some UK banks because I was eyeing these things that they were really bad. Lloyd's. It hasn't made anywhere near as big of a comeback as Wells Fargo. But I mean, the UK situation is different, and I think maybe a little more bleak. This isn't too surprising. You can look at the UK ETF, which is EWG. Oh no, that's Germany. EWU. Yeah, there we go. So the Lloyd's chart looks kind of like EWU. There's a big resemblance there. One of the big pair trade themes that's going on for a while is like long QQQ, short EWU, or even short EFA. And that has not really gone a whole lot of anywhere since August. So that's kind of interesting. Go back and look at Germany again for a second. Yeah, the Germany chart just looks so much stronger than United Kingdom. So let's look at EWG, EWU. Yeah, a lot of that outperformance is from 2020, so maybe that's a little deceiving for the picture right now. It looks like it's been moving kind of similar. All right, what do we want to move to next? I was listening to a guest from Friday on Samantha Leduc YouTube channel. I think Dirt Nap Report, something like that. I forget the guy's name. Sorry, it's on my Twitter though. So at Jon Tait on Twitter, JONTAIT. If you go there, you can see where I tweeted out that podcast from Samantha. It was really good. He was talking about Japan. He had a really positive view on Japan, and it's actually really been running. Pretty good call from that guy. I don't know when he got in, but. The Japanese ETF doesn't look like it has a whole lot of overhead resistance. Yeah, it's been strong for a while. I wonder how this stacks up to QQQ. EWJ colon QQQ. Yeah, look at that. Underperformed for a decade, and now it looks like since the coronavirus, let's call it the panic in 2020, Japan has been keeping up with the QQQ. So that's really interesting. It might be worthwhile to go into the Japan ETF and take a look at what some of the top holdings are. So I'm going to open up a window now to Yahoo Finance, and we will do that. Holdings. EWJ, top holdings, Toyota Motors. I think that trades in the U.S. under TM. Toyota Motor. Yeah. Okay, great. That's good to know. Pretty good volume too. I wonder what the average options volume is. Oh, that's a monthly. Hang on, that's a little misleading. Yeah, it looks like it just broke out. So, given what's going on with all the electric vehicles, Toyota Motor, they may be getting into the fray. I don't know how this is doing relative to GM. So let's kind of do a little race off here with a ratio chart. So underperformed GM for a while, although not last week. What else? Sony, SoftBank. Nintendo. That's so cool. Nintendo is like a top 10 holding Japanese ETF. I grew up as a Nintendo kid, so it's neat to see that. Huge market cap there. Something I wish I bought as a young gamer kid was NVIDIA shares or like calls or something. I mean, that would have just been awesome. All right. I mean, it was hard to predict. That like, NVIDIA was going to get so big. I mean, they're just another graphics board maker, and I mean, there were a whole bunch of them. NVIDIA maybe emerged as the top dog, but I don't know how many people remember like the Voodoo cards from back in the day. But I mean, where's Voodoo? How could we know that NVIDIA was going to like go on to be such an important semiconductor stock? Really hard to predict that stuff. I mean, some people saw it. I'm sure. I'm not sure what a whole bunch of these other ones are. So I'm not going to read them all off. For people who are just listening. Now let's kind of flip over to look at some of the most active. Interactive Brokers has a really wonderful most active screen, and I've gotten a lot of really helpful heads up from that screener. So I'm just going to kind of go down my list of notes. Teradata Corp. Huge breakout on this. Excuse me. Looking at the daily chart, looks like it's going through a little bit of a consolidation here. The volume coming in here, this just looks like a Nicholas Jarvis kind of stock. Because you've got huge explosive volume coming in, and then it's kind of stair-stepping higher. So Jarvis would be looking probably at a box, a 45, 60 box right now. I don't know that I would necessarily jump right in and buy this here. I might wait for a down day if I were going to take a position in it. I don't know what Teradata does though. So let's go look. TDC. So by the way, trading homework. This is not like. This is not like a report where I already did all the research. This is like live research. So, okay, hybrid cloud analytics software. That stuff is big right now. Okay, the company business consulting services include various offerings such as consulting to help organizations establish analytic vision and identify and operationalize analytic opportunities, as well as enable an analytical ecosystem architecture. It serves various industries comprising communications, blah, blah, blah. Okay. Has a strategic partnership with Deutsche Telekom. All right. Let's look at some key statistics real quick on this. Maybe we can see the reason why this is suddenly interesting. What's the float? 107 million shares. Okay, so not a tiny float. Short percent of float. This must be the reason why it's been so explosive lately. It looks like 24% of the float is short. I don't know why people would short a company like this. Maybe it's just a part of their portfolio. It may be that they are long Datadog or something like that, and they're short this one. In fact, let's look at that. Let's race it off against Datadog. D-Dog. Okay. Well, that's pretty interesting. Let's flip it back to TDC. So with a stock like this, it's moved up a lot. It's really fast. So one of the things I'd be looking for here is high tight flag pattern to happen. So a high tight flag happens when a stock takes about 8 weeks within about 8 weeks it doubles, and then it starts flagging sideways, very near the highs. It's already come down off the high near 60 by quite a bit. But I would suggest that it's still kind of in that region where, if it stays kind of between 45 and 60 and flags around the maybe near the higher end, near 55. For 3 weeks, around 3, maybe 4 weeks, and then breaks out from that. That is, if you read William O'Neill's excellent book, How to Make Money in Stocks. He's on the fourth edition now. If you read that book, you'll learn about the high tight flag, where off of a base like this, it's one of the strongest chart patterns in technical analysis. And look at this volume explosion. It's just huge. It kind of falls into the Nicholas Darvis candidates as well. This is the one I'm going to be keeping an eye on. I don't know that I'm going to just jump right in on Tuesday or whatever. But I found this from the most active list on the Interactive Brokers Screener. Next one. Saba. I think this is what is Saba? Just huge move here. These are the kind of things that are possible. Like, stock doesn't have to stop running. It can, what if this is the bar right here that we're looking at on TDC? And then like next week looks like this. These kind of things happen. So I don't know what the deal is on this one, but what a run here from $1.50 or $1 up to like $10 or $11, and then what a letdown later. But it looks like a biotech where anything can happen on these things. I favor really small allocations of these things, if anything. So let's go take a look and read about Saba. Cassava Sciences Inc. It is a clinical stage biotech company, developed drugs for nervous system disorders. Okay, its lead therapeutic product candidate is a small molecule drug. Okay, that actually sounds like something that could be helpful. Look at that, a blood-based. They also have a diagnostic product, a blood-based biomarker diagnostic to detect Alzheimer's disease. Whoa, that sounds really interesting, actually. Formerly known as Pain Therapeutics. Okay, well, that is Alzheimer's detection and treatment is something that's near and dear to me. That has been an affliction in my family history. So, what a noble cause. So let's zoom in on this. We're looking at the weekly right now. Let's count these weeks, these up weeks. 1, 2, 3, 4, 5 up weeks before there's finally a correction. And in those 5 up weeks, just huge moves. So maybe they really are onto something. But you have to look at what's possible. Look at this down week from $10 to $2. So what this means is the put protection that you might buy on a position on Saba, you can expect that to be really expensive. But it may really pay off. So you can maybe try to leg into it and like buy the call on a down day and then buy the put on an up day kind of thing. That carries some risks as well. Some people are crazy. They'll put their whole account and stuff like this without even any protected puts or anything. Not my kind of thing. All right, so this actually looks like it may be at a buy point here. The reason I say that is it looks like there's earlier support near between 40 and 45. And so if you get your money in near, somewhere around 50 or less, between 45 and 50 or less, you can know if you're wrong and need to back out pretty quickly. The other thing I'll say is I have seen lots of charts like this that do break lower and just keep running lower. So Why don't we flip over to IB and look at this in the options, in the little options simulator thing here. Let's look at Saba. Okay, Saba Sciences. All right. So at the money call, look at this implied volatility. I mean, it's big, but it's down a lot from the historical. And I mean, that's not surprising. I mean, this is just crazy high implied volatility. When it's this high, there are some other things you can do. Also note that this only has monthly options. So that really restricts the kind of combos that we can make, unfortunately. So not really my style to do this, but I know that a lot of times what people will do is they will, if they want to take a long view, something with really high implied volatility, they'll do is they'll go in there and they will sell a put spread. So that might be, yeah, I think the bid-ask spreads on this are wide. So that really does kind of restrict what we can do here. There's another tactic you can use is you can buy a slightly out of the money with a call option, say 20 or 30% out of the money with about 6 weeks to go, and see what that looks like. That's a way that you don't have to like maybe commit so much money. And so let's try a combo like that. If we buy a 65, let's look at if we throw in a little protection. And it's really expensive. What do we get here? Okay, so that's kind of a swoosh. The problem here though is we're gonna have pretty bad time decay from both legs, and so what you can expect here is that this time decay is gonna hit both legs of these pretty hard if it's not moving. The nice thing is if any price movement in the beginning of this is sorry about that spam call I don't need to take. Yeah, I mean, it would take some price movement to get you up out of this groove. And the other problem is, like, if we look out a week, it has to really be moving to get you out of this groove. So maybe there's another way to play this. Earlier in the broadcast, we were looking at, like, pretty far out on the calendar, like a January of next year kind of thing. What do these prices look like? Really, really expensive. I mean, sometimes the way to go is just shares. So what you could do, where the options are ridiculous, is you can do a covered call kind of thing. You could buy the shares at 46, and you could maybe sell some calls, but I don't know. Maybe just a way to play this one is just straight up with the shares. If it's marginable, then that's kind of reasonable because let's look at why. So say you wanted to carry a position with options. You could do a synthetic stock. And so let's look at a synthetic stock in March. To do that, what we do is we buy an at-the-money call, and we sell an at-the-money put. And if you look at that, so you're actually getting a credit to do this, which is kind of interesting. I mean, you may get exercised on, though. You're gonna have to look at what you have to put up in margin to do this. You have to put up $5,000. That's how crazy expensive these options are. If the shares are marginable, then what you could do is you can put up what, 2,400 bucks to get 100 shares. Per 100 shares, 2,300 bucks. So this is a case where the synthetic stock is even more expensive. But the one reason why you may want to do this is because you're getting this credit. So if the shares go up, then I think you're in a situation where say the shares go up over the course of this month. You're in a situation where you will get to earn this credit, I think, because the put that you sold expires worthless, and the call that you bought would expire in the money. So that may be a reason why people are doing that. But I don't know that that's worth it. $500 of credit when, if it's marginable, you could just buy twice as much shares. But that's going to have more downside. So anyway, that was a fun little exploration of cassava sciences. All right, let's move on to Mara. I've already talked about Marathon Patent Group on the Trading Homework broadcast before, so I don't want to necessarily dive into it a whole bunch. What I want to call out about this one is that what they do, and I'll show you, is you might think that they're just like buying patents and sitting on them. That's what the name kind of implies. I think they actually kind of tweaked their business model, because I took the time to look this up. The first time I saw it, I just ignored it because I'm like, oh, patent company, I'm not interested. But when I went and looked it up, because it was just sticking on my screens, and it was running similar to Riot, which I have a position in Riot. So Riot blockchain, right? So look at Marathon. Marathon Patent Group operates a digital asset technology company that mines cryptocurrencies. So it's a cryptocurrency miner, similar to Riot blockchain. Company was formerly known as American Strategic Minerals Corporation. So I don't know if they actually were, and look at that, it's headquartered in Las Vegas, Nevada. So I don't know if they were originally like a for real metals miner or something, like a precious metals miner, and then they tried to like hold patents or something. This looks like a company that has rebranded itself. And so there may be a little bit of a negative connotation there, but at the same time, like, if they can change alter their business plans strategically to go for where the money is, it's not necessarily a bad thing. I mean, it sounds like they're kind of operating almost like a holding company or something with a pretty broad charter, it sounds like. But nevertheless, it's interesting. So I want to show you this compared to the Riot chart. So let's do another one of these little race-offs. So we're looking at a ratio chart with Marathon Patent in the numerator and Riot in the denominator. And you can see that there are times where Marathon outperforms and times where Riot outperforms. So interestingly, this actually presents opportunity, because what you can do is, if you have Riot and you have Marathon, you actually like switch your Riot over to Marathon now. And then when Marathon outperforms, you can switch your Marathon over to Riot. So I may actually do this because I'm in Riot right now. And that's been outperforming Marathon Patent, but it may flip back over. And so, if this ratio chart goes back up, and it looks like it's kind of oscillating, it's got an oscillating behavior in the price history, with Marathon trending higher, by the way. So this looks like maybe kind of a buying opportunity here, assuming that we open on tomorrow on Tuesday. So I may actually flip my Riot over to Marathon if the options liquidity looks similar. So let's take a look at that, because Riot has great options liquidity. So let's take a look at that. I'm going to bring up Marathon here, and then let's compare it to... okay, it's not going to tell me the average options volume here right now. That's okay. We can maybe tell from the open interest. So let's get two windows open. I already have a Riot window. Let's just flip this one over to Marathon Patent. Okay, yes, they have weekly options. That's great. So what I want to do is look at, so there's a June expiration. Let's look at Riot. I think what I have in Riot is a July expiration. More, oh, it's also June. Okay, great. So the duration is the same. So I have an at the money call on Riot. Or no, I'm sorry, this position is old. It was at the money at 18. Wow. All right. Well, what I may do is just shuffle a similar position over, but the prices are different, right? So Riot's at 48. What's Marathon? Marathon's at 38. So I could just kind of reset a brand new swoosh position, but let's compare the open interest here. So at the money open interest, that should give us a pretty good feel for how liquid these options are too. So by the way, in case it isn't obvious, what I'm telling you is a way that you can play cryptocurrencies is not just by buying the coins, but you can actually do options trading on these miners and blockchain companies that have liquid options markets. MicroStrategy is a big one that's in the news right now, but their options market is not very liquid. But Riot and Marathon both have pretty liquid options, so that's super exciting to me. So at the money options for Marathon patent, we got gosh, almost 8,000 contracts, but it quickly drops off. So at the even round numbers, there's a lot of liquidity there. At the odd numbers in June, it's not so much on Marathon. If I flip over to Riot, at the money option for Riot would be 50. There's barely anything there. So it looks like Marathon patent is actually a more liquid options market, but maybe just slightly. So that's great news. I mean, these are both pretty liquid. Bid-ask spreads. These are closing prices. They're not going to be super accurate. But if we look at the money bid-ask spread, what do we got here? $1.50. Okay, it's not too bad. Let's look over at Marathon. At the money for, oh, that's the wrong thing. For Marathon, well, let's look at 40. Yeah, it's fairly tight, less than $1 there. But I mean, it gets wider at these other strikes. So if I was going to move over to this, I'd be realizing a really large gain on Riot. I don't know that I would want to go into an exactly identical position. What I might do is see what I could build for a swoosh position. The implied volatility on this one is huge. 234% for Marathon patent. For Riot, 247%. So they're very similar. What I may do is like roll into a like position. With the expectation that Marathon starts to outperform again, or at least not underperform on the downside. So let's look at a swoosh position on one of these. I can't imagine that it would be attractive at these price levels. When I got in, it was, this was like a lot calmer market. So at the money, June would be a 40. So if we bought one of these, now here's how we would want to structure protection on this. We're looking at short dated with ideally more than 2 weeks to go, probably not more than 4 weeks to go, with a 25 to 30% of the price of the call we're buying. So I'd be looking to spend about $4 $4 price on a contract for a put. So let's go out here and look. I'm looking about 10% out of the money, so at 36. Yeah, it's way too expensive. But if I come in on duration, maybe it gets cheap enough. Nope, still crazy expensive. So building a swoosh now on this is just, it's too expensive for that, really. And I'll show you why. Like if we put this in, we'll go back to the 3 week here. So, I mean, the put contract is going to have really, really high time decay unless it goes down a lot, and it doesn't protect you as well. If you notice, like it takes a long time for that to kick in because with this put being so expensive, what this is telling you is at expiration, this put is going to be not worth anything to the buyer at anything over $30. And so, you know, it's so expensive to get protection on this right now. And I'm not necessarily bearish on it. In fact, I'm like crazy bullish on these in the short run because I think there may be a scramble out of the dollar by Fortune 500 companies trying to shield their balance sheet from the dollar by making at least some allocation into cryptocurrencies. Which, I mean, this whole thing is getting nuts. I read a tweet earlier today from somebody. They were saying that the energy consumption from cryptocurrencies, and it might have just been Bitcoin, is higher than the data center electricity bill of, I think it was Apple, Amazon, Facebook, like all the big tech names. And so, I mean, that's extraordinary if that's the case. So, I mean, as an environmental concern, that's really interesting if that's true. Okay, so what I may do is instead look at just moving the in the money call. So with Riot, what I have is an 18 call. So let's figure out what percentage of the price away of a call I would need. Oh, shoot. Don't do that. All right. Let's put it right there. Okay. So Riot is 49. 18 divided by 49. It's 36% of the price, or 37. So, looking over at Marathon, if I look at a call in June that's 37% lower, I can take 38.5 times 0.37, and I would be looking at rolling into a 14 call in Marathon, and I might also buy like a short dated 14 put or a 13 put. So let's look at what I'd be rolling into. And I'm showing you because I'm showing all this stuff because, you know, you guys might find yourself in a similar situation. You might you might have Coca-Cola, but it turns out that like Pepsi's cheaper on a relative basis, or you might have Ford or GM and you want to do a similar kind of thing. You know, if one of them gets really expensive relative to the other one and you have a reason to believe that it's a temporary phenomena and that relationship oscillates. I'm showing you the process that I'm using here. Okay, so let's look at Marathon. Let's look at June. Let's look at a 14 call. I got the legs cleared off. 14 call. And let's look at, with 3 weeks out, I want to look at a 13 put. I'm going to add that in there. And so the price of this thing is $27. I'm not sure what the price is of the one that I'm selling. So let's look at that and see, would I be like actually like realizing a gain here or just doing a move? Because if I'm realizing a gain for what's essentially like maybe a similar position, that's a value play. Like I'm trying to be like a value trader here. What I have on Riot is the 18. Yeah, that's already more expensive. The 18 call, and then I've got the 17 put for March. Okay, and so this one I can sell for maybe like $34, assuming that prices open similar to where they are now. I could sell for $34 and take a position for $28. So that's realizing $6 of gain. And I think maybe giving myself a chance at more upside. You know, if Marathon is falling behind just because of like maybe Riot's just in the spotlight right now. The risk I run is that Riot actually has a better business model than Marathon Patent, or that they have a better algorithm for choosing which cryptocurrency to mine. The reason I'm not too worried about that is because when I look at this ratio chart here, let's actually zoom it out some. You can see that like there's a pretty solid relationship here, where they tend to move together. If one gets out of line, it swings back. And so I know a lot about this kind of stuff because of precious metals trading, where I'm trading one kind of bullion for another. Like if the price of silver gets really cheap compared to gold, I might switch gold for silver. And then when silver gets expensive relative to gold, I might trade the silver back and exchange it for gold. I talked about that. If you're curious about that, I spoke about that with Chris and Micah last night on the trading homework from February 14th, 2021. So you can go back and watch that broadcast, the replay for that broadcast, if you're curious about precious metals trading, switching in that way. So, yeah, all right. Well, that's a really helpful move. I'm gonna like add that to my notes for actions that I'm gonna take tomorrow. So switch switch Riot position. I'm gonna call it a rotation. This is rotate from Riot 18 call to Mara 14 call. These are June. Note that. June call. Sorry, I'm updating my notes off screen here. The other thing that I need to do on Tuesday, I mentioned at the beginning of the broadcast, it's Monday. The markets are closed for President's Day today. So Tuesday is going to be like a Monday. It's going to be weird. The other thing that I need to do is I have a position on that has a really short-term put that I need to roll on Tuesday, and it's Tilray. So let's look at Tilray, because Tilray's their implied volatility is through the roof. What I did is I actually like sold this around 63 or 64. I had a position in it. It was a swoosh position. But the implied volatility went through the roof. And so I just closed the whole thing out. And then I bought it back on I think this was Thursday here, near the close, not all the way at the close. I got it at 33 strike, which was at the money at the time. And then at the close on Friday, like right near the close, I rolled that down to a 29 strike. The problem is that I have a 27 put that expires next Friday. So it's only got 4 days of expiration. What my plan, I think, to do there is I need to roll that Tuesday, because I want to get it where it has more than 2 weeks of expiration left to go. And I have to do that slowly. What I'm doing is I'm moving further out of the money, because I've got it really close. My call is a 29 call with a 27. That's less than 10% away, but it's shorter time to go. And it looks like a swoosh, but it's only going to look like a swoosh for like one more day. So I've got to roll out the put, and I'll probably roll it down to a 26. So let's just look at that real quick. That's the other chore that I have on Tuesday for my positions. So let's get another tab open, and we're going to look at Tilray. So So let's look at the position I rolled into first. We're going to go to Strategy Builder. All right. So what I have is a June 29. That's a put. It's not a put that I have. It is a call. $11. And then I've got the protection I've got is a 27 for February 19th. And so if you look at this in the simulator, we zoom out a little bit, it looks like a swoosh. And I've got protection. Like if the price falls, I can, I can set my cost basis lower, although it's not protecting me really great. And so ideally, if I'm lucky, the price will open kind of where it is or higher. And what that'll do is, it'll hurt this put that I have here, the 27 put. But looking out to next week, what I'm looking at getting is I'm going to pay up for a 26 put from February 26th. And I'm probably going to, by Friday, have to roll this again. So pretty aggressively rolling it, and my hope is that the implied volatility will drop. I mean, there's a whole lot that can happen. Like if the price cracks lower, it looks like on this simulator that I don't have as much protection as what I'm claiming. But the problem is that the price cracks hard. Say it falls from 29 to 25 or 24. I mean, that's a big drop, and it looks like I'd be at a loss of $260 on this position per combo. But the implied volatility is probably going to be higher. And so what it'll do is actually it bumps this whole line up. So it's a pretty dynamic situation. So if we look at what it looks like with what I'm proposing rolling into. It's a similar chart, right? But it's got more time on it, which is important because that other one was going to age so fast. But this one I could maybe make it to Friday, which was February 19th. I can make it to Friday before I need to roll that put again. So it's really expensive to have protection on this thing right now because it just fell 50% in a day. Or maybe it was 48%. I don't know. I thought it was down 50% at one point. Okay, I've got more stocks to go over. Let's keep moving. I'm going to just add this to my notes real quick before we move on. Roll Tilray 27 put out 1 week to 26 put. All right, got my notes updated. All right. Looking at the watch list, so we've been through 3 of them here, TDC, Sava, and Mara. And that was actually a really productive session for me because we found that opportunity to make a value trade out of Riot and into Mara. Now let's look at Veru. VERU. I don't have a position in this yet. But, I mean, it looks fantastic. Again, this is like a Darvis box kind of stock that I really wish that this was on my radar sooner. I probably would have been in. I would have been in on this breakout right here if it had been on my radar. Breakout up to like 14.5. But it's only 21 now, so maybe still a long ways to run. However, it's down an awful lot. I'm sorry, it's up an awful lot from these lows. It was basing for who knows how long. Let's take a look. Around $2. I mean, if you go back a couple of years, it was like $1.50, $1.60 stock. Let's find out what this company does. VERU. Oops. Okay, it worked. First of all, is this a U.S. stock? I really favor U.S. stocks. Okay, it's a biotech. Now I'm a little less sweet on this one. I'm not the biggest biotech fan because these stocks can just collapse so epically. They've got an address in the U.S. That's nice. Okay. Oncology biopharma. Focuses on developing medicines for the management of cancers. So cancer treatment, okay. Its commercial products comprise FC2 female condom / internal condom for the dual protection against unintended pregnancy and transmission of STIs for ministries of health. Okay, this seems a little weird. I mean, maybe it's a cool thing though. I don't know. I don't know anything about it yet. Again, this is a research session, right? It's trading homework. I'm just kind of like pulling back the veil on some of the reading and things that I do about companies. So it looks like female reproductive health. That's cool. I didn't know that. I didn't know that there was products like this. Looks like they've got something for treatment of breast cancer too. It looks like they've got some things for men also for prostate cancer. That's cool. I'm a little bit skeptical about treating cancer with drugs because I eat vegan. People who follow me on Twitter long enough know that I eat a vegan diet. It doesn't mean I'm invincible from cancer or anything, but I think that like healthy eating can be a part of cancer treatment. Although I'm not a doctor or a lawyer or a financial expert or whatever, a registered financial advisor. So, these people are the experts, I guess. All right, so let's take a look. When you see a chart like this, it means something's going on with this company. And an ideal buy point, I mean, it's not at an ideal buy point. Like if you get in now, what you're doing is you're chasing momentum, and that can work out really well. I mean, this thing is not moving so explosively that it looks either unsustainable or that the IV is going to be through the roof. I don't know if they have weekly options yet, so let's go take a look at that. This might be the kind of thing where you could just put a swoosh on at the money, and if it drops, then you can lower your basis if the implied volatility is not too high on the stock. So let's go take a look. The other thing with this is, if something really bad happens with news for the company, if you have a swoosh and you're able to get it at a low IV, oh no, the IV's to the roof, 188. All right, well, may not be much opportunity here because it's got monthly options and a really high implied volatility. So again, this may be a case where the best way to play it is to just buy on margin some shares. And then what you could do if you get scared is if you're really close to options expiration, look at how cheap the puts are. So what you could do is you can buy some really cheap puts. The other thing you could do is you can buy some like out of the money calls for really cheap with a short expiration. So a stock like this, it can double by the end of the week. If it does, just take a look at what happens if you get some of these $30 calls. They're very inexpensive. It has a low profit probability, of course. But if it moves up 100%, what are we looking at here? Moving from an investment of $62, return of $1,200. So that's like what, 20 to 1? 21 gain. I mean, I really wouldn't spend a whole lot on that, but that could be a way to get started on this stock. And a lot of times these companies, they're aware of the options expiration dates, and they may sometimes time their news around that. That happened with QS last week. And I was watching it the week before. Like, if you go back and you look at my broadcast from, what was the date? I'll tell you the exact date. If you look at my broadcast from, I think February 4th was the date. I was talking about, or no, it would have been February 3rd. I was talking about next day option expiration plays that you could get on Thursday because we were getting ready for that on Wednesday night. And I think we talked about QS at that time. Well, had I revisited that on the 10th and been ready to buy that on the 11th, I'll show you what that thing did. QS. Look at this move, 21% gain on Friday. I don't even know if this came from news or not, but this was one that I missed. Well, I probably would have been looking at getting like a 50 or 51 call. So, I mean, that would have been nice. Let's take a look at what that was. Oh, we can't. It's expired. Sorry. But, yeah, that would have been a really nice gain. And when you get those, like it pays for, it can pay for a lot of the losers you had along the way and a lot more too. So I call those 1-inch punch kind of trades. A 1-inch punch trade on Vero would be if Tuesday we see that it's still lining up in this base, or maybe like getting ready to make a new high. Just remember the strikes only go up to 40, and so looking at these, if say it has a down day on Tuesday. But it's above 18. You're going to see that these calls that are out of the money here in the range from 25 to 40, these are just going to get hammered. They're going to get chopped in half probably. And so that's probably when I would strike. And there are two ways to do it. Like if it gets hammered on Tuesday and there's 3 days to go, what you could do is you could do a bull call spread, but probably they'll be cheap enough to just buy one. So if you could get this for half the price, just take a look at the performance profile here on the 25. It goes up 100%. It turns into big money, and it doesn't all the way out here on the simulator here. It doesn't matter if this option fell. It got cut in half. It went from 85 cents to 45 cents on Tuesday. It doesn't matter. Like it's still going to be worth on Friday around $1,000 in a range of 35 to 36. Like this probably won't change no matter what price you buy it at. It's just that you could buy twice as many if you get it for really cheap. So. Instead of turning $85 into $1,000, you turn $45 into $1,000, and it maybe many times over, depending on how many of those calls you bought. But if you do these 1-inch punch kind of trades, just be aware that how many 1-inch punches do you think Bruce Lee is landing in a fight? Like it's probably not that many. It's a move in his arsenal. He can use it tactically when the time is right. So my point is, don't go heavy on these. Go light, sprinkle them around. A lot of times, I'm just buying little onesies, twosies on a dozen things. If I find a dozen opportunities for it, I didn't hardly get into any last Thursday and Friday because I didn't see a whole ton of opportunity for it. But I made an error, though, on Thursday. I wasn't looking through all the charts that I'm watching during the trading day, or even just at some point during the trading day. And I'll give you a tip I learned from poker. So I grew up around poker. I should say later on. I had two former roommates back when I was 20-something that were pro poker players. And these are, at different times. But Phil Ivey is one of the top pro poker players. Anyone who follows poker knows that. And I made a really important observation about Phil Ivey that helped me in trading. Here's what it is. If you look at that guy, his eyes are always darting around the board. He's always looking. His eyes are always moving. And the reason is this, like he's actually absorbing so much information, and he does it in a way that doesn't really reveal a lot of information. So he's got a really great memory, but really what he's doing is he's reading all the players, and he's reading their body language. He's looking for new information, and he's constantly updating his internal mental model about what's going on at the table at all times. And so what I found is if I keep a good watch list and I go over it multiple times throughout the day, or if you're a longer term trader, if you just click through every chart on your watch list, after the market closes every day. So even if you aren't in those stocks, just keep apprised of what's happening with them. And also like keep your watch list up to date. If you do those things, it will give you an advantage. And I just got lazy on Thursday, and I missed that opportunity. So, and that's a double-edged sword too, right? Because you can, if you overload yourself with information, then you might have a lot of dirty signal mixed in with the clean signal. So that's something that everyone has to manage differently, because what's a dirty signal for you is different from what's a dirty signal for me. Okay, so there's Veru. It's got monthly options, but guess what? We're in options expiration week next week. So, I mean, that's a really good thing to know. I have another list of stocks that only have monthly options, but that look really juicy. So let's go through those really quick. And I'm going to try and keep in mind that, on a down day for any of these stocks, there might be a 1-inch punch trade kind of opportunity. And so to keep an eye open for that. So Veru is one, and I'm going to add that to my monthly only list here. So here are the other ones. I pulled these from the most actives list and maybe a few other places, but the most active screener from Interactive Brokers is really great. There are plenty of other places to get most active lists. I think investing.com, I think they've got a pretty good list. Also, FinViz Screener can be used for most actives too. They keep a most actives table, and then you can filter them based on prices and things like that. They also have a way you can look at relative volume on the screener, and probably we'll take a look at that later on. So, okay, so this is Tigger. Let's just peek in Yahoo Finance at what Tigger is about. FinTech Holding Limited. Okay, that's cool. It's a NASDAQ stock. Profile. Up FinTech Holding Limited. What a great ticker sign they have too. Provides online brokerage services focusing on Chinese investors. Okay, suddenly I'm a lot less interested. It's based out of Beijing, China. So I'm not too hot on Chinese companies. It doesn't mean that I don't turn my nose up at a great profit opportunity. But I don't really like to be an investor in Chinese companies. Like trading them is fine for me. But being an investor in Chinese companies is not something that I generally do. I do have a position in NEO that is. I took it because it may be that there's a breakout opportunity here. This looks like a great base. It's just been stair-stepping higher. I may pivot that over to CCIV though, and just rotate out of the Chinese company and into an emerging U.S. company that's in a similar space. This one's great. I got into this one on Friday. But anyway, back to Tigger. Sorry, I kind of ramble on these. These are just brainstorms. And by the way, for anybody watching, like if you want to drop stuff in the chat, I see Chris is in the chat. All right, he's talking about he's got a bunch of screens. Hey, Chris, if you want to call in, call my phone, and I'll put you on speakerphone, and you can join in. I'm going to text you that too in case you already dropped off. I'm not sure who's on right now. Who all's on? Hang on one second while I text Chris. call me if you want to join the broadcast. I will put you on speaker. So Chris was on last night with me. If you haven't seen that, it was a really great broadcast. Did a lot of brainstorming. Hopefully he's not like in the middle of dinner or something. But yeah, you could go back and watch yesterday's broadcast with Chris and Micah. It was a really fun brainstorm. Okay, so Tigger, we're going to look at the options on Tigger and see if there's a liquid options market here. All right, looks like Chris is calling in. All right, 1 second. Hang on while I get Chris connected. Chris, hey, I got you on speakerphone. All right, I hope the audio comes through all right for everyone. I have a pretty good mic, so it should. All right, well, go ahead.
I was messing around, and I was going through Twitter, and I saw you were on. I was like, oh, let me watch Jon for a little bit.
Yeah, awesome. All right, hey, just don't forget to, if you're still watching on your side, just don't forget to mute your volume there. Otherwise, you get an echo.
My TV, I popped it onto my TV real quick from my iPad.
Okay, cool. All right, so just one thing for everybody. Chris is on speakerphone with me, and so he's going to be watching the broadcast, which has a slight delay on it. The reason it has a delay, it's a really short delay, is because of the video quality. I need it to be high enough so that people can read the numbers on the screens. And so because of that, that's where the delay comes from. I didn't put a delay into it. I'm just telling you, like, YouTube has a little bit of a delay because of that. So, all right. Anyway, so yeah, Chris, just to catch you up, what I was looking through right now is we're going into options expiration month. Options expiration week next week for monthly options. And so a lot of the stocks that I watch come from most actives lists. Interactive Brokers has a really awesome screener for that. And I don't necessarily do a lot of things with monthly options expiration stocks because if they don't have weeklies, there's a reason. And the reason generally is that they have a less liquid options market. And so, it's not liquid enough for them to have weeklies yet. And sometimes that changes. Like I was watching ARK for a while. They only had monthlies. And then I noticed right away when they introduced weeklies. And I'm like, all right, great. Now we can add ARK to the weeklies stuff. But anyway, the reason I'm bringing it up is because I've talked about these 1-inch punch trades where if you watch Bruce Lee do the video clips where he does the 1-inch punch, he's generating like a tremendous amount of force with a very small amount of motion. And so in the options world or in the trading world, we have a similar thing with when options get really close to expiration. It means that like all that time values went out of them. However, if there's a big price movement, in the last few days, then it can take that option and jam it into a really profitable spot on the curve where it actually has substantial value at or near expiration. And so we can go from options that are worth a nickel to options that are worth like, I don't know, dollars, just thousands of percent return. But the likelihood of it is very low across all of options world. And so it's our job to kind of narrow it down to just the high probability ones and be watching, So if on Tuesday we get a down day in some of these stocks, but the market's holding up, then we might capitalize on that by putting on an out-of-the-money options trade for dirt cheap and maybe catch a big up move. So I'd be looking at calls probably more than puts on these because, these most actives are, depending on where they're at, if they get super overbought, maybe you can have an opportunity on the put side too, or maybe a strangle, but...
yeah, I call that trade as hero or zero trade.
Yeah, hero or zero, yeah. Definitely. So, and just so that people have a feel for the style I'm using on these, like, I am not allocating much capital at all to these, like really, really small amounts.
Right. Absolutely.
Yeah. So,
You really want to put up 10% of your portfolio on that.
oh my God. Well, I mean, I trade like a maniac, but not suicidal. You know, like I'm not a YOLO trader, but if most people had my portfolio, they'd be puking every week. So,
So you are looking at calls, understandably, the bias.
yeah, but it depends though. I mean, if the thing's overbought, and I'll tell you my overbought metrics, like let's just review those. Where the daily RSI is like 80 or higher, the weekly RSI is like 80 or higher, and also that the share price is more than 90% higher than its 50-day moving average. So if you take the 50-day moving average price, you put it in a calculator and multiply it by 1.9. If the share price is above that, then it meets all three of those criteria, which I would call it then overbought. And so it doesn't mean it can't keep on getting more overbought, but that it can be very vulnerable to big sell-offs.
I never thought about that. That's a good metric. Like the 129. I like that.
Thanks. Yeah, here's where it comes from. I did a study early on in my trading. I don't want to call it a career, but let's just call it in my trading time. I did a study of Taser, which was one of the most breathtaking, amazing moves that I had seen.
I remember Taser.
Yeah, Taser was wild. And I did a study of Taser, and what I found is it never really got above that 1.9 multiple of its 50-day moving average. Every time it got up near it, it would just start basing for a little while. And, it would sort of work off that overbought state, and then it would break out again and run higher. And when it got close to that 1.9, it would start basing again. So, and I found this, it didn't just apply to Taser. It applied to a lot of stocks that were really, really strong. Excuse me. I mean, we're in such a market right now, though, where this is like a 1999 kind of bull market with some of these stocks where, we're seeing a lot of stocks run kind of like Taser. And, I mean, it's wild.
Even in the pink market, I'm astounded
Yeah.
at the moves they're making.
Yeah, it's crazy. It's crazy. So yeah, I'm going through. I've got a list of it's a pretty short list of monthly options. I've got Tigger up on the screen right now, and so let's look and see. Can we say Tigger's overbought or not? It looks like it maybe kind of was, but it's working it off now a little bit. So RSI on the daily is about 80. Let's flip over the weekly. RSI is 87. Now let me flip back and I have a calculator window here, and let's do the calculation for the moving average there. So 50-day is 1294. I don't even need to do the math. It's higher than it's more than double the 50-day moving average. So this one is overbought. So for Tigger, what I'd say is maybe a strangle instead of just a call.
Okay, you just switched your weekly over here.
Yeah, I know it's got that lag, but it's because YouTube's trying to give you like really high quality picture.
No, I hear you.
Yeah.
I hear you. I'm just letting you know how far behind.
Got you. Okay.
So let me pull up Tigger on my iPad real quick while we're chatting.
Cool. All right. And while you're doing that,
I'm gonna lose your screen. Never mind. I'll just follow you.
Okay. So I've got Tigger on the options window. It should show for you in just a minute. And on February 19th, which is in 4 days, so at the money is $30. So yeah, probably what I'd be looking to do is like leg into this stuff like real cheap. So like if the price is up, then I probably like leg into the put, and if the price is down,
I'm sorry, what track are you looking at?
Okay, so at the money is 30. So like if the price is up on Tuesday, I'd maybe look into like legging into a strangle with the 25. I'd try and get it a lot cheaper than 50, And then hang on, let me go into the combo thing, the strategy builder here. So and then if the price when the price goes down, then you look at legging into the 35. And so anyway, it looks like this. I I don't know that Tigger's going to have a 100% move. Let's see here. What could we expect? A 30% move from Tigger? It could do that.
What's the ATR on Tigger?
Oh, yeah, good call. Let's go look. The daily ATR is $3.
Oh, that's high.
Yeah, it's high.
It's not 4 or 5, but,
Yeah.
it's
So,
up there a little bit.
I mean, I would be looking to leg in on these. I wouldn't try and like put them both on at once. Probably, like I would fade whichever way it's going.
Right.
And that may fizzle out and not turn into anything. But I'm not trying to spend like $1.35 per combo here to have a straddle on this thing for that far apart. Like I think it can be had for cheaper if you're tactical about it and leg in. So I mean, the other thing is like just time itself is going to burn these out of the money things up. So
And the beta is
it's
7 cents each. Each? Oh no, 20 cents.
yeah, it's high. I mean, these things are going to burn up fast.
Yeah.
So anyway, all right, well, let's keep moving. I don't know that we need to like dive into all these because they're all going to look like that, in the options builder. So let's just like look at the opportunities here. I already looked at Veru, so let's jump over to Open now. And I looked at Open earlier on the broadcast, and I mean this is one that it's Open Door Technologies. Let's just look at what they do real quick. I think it's kind of like a Zillow play.
Oh, you still got Corsair up there, huh?
Oh, what on my window? Yeah, probably.
Yeah, your simulated trading.
Yeah, we were looking at.
Yesterday when I pulled out the P5, that was Crucial, not Corsair. Anyway.
Oh, okay. So here we go for Open. Open Door Technologies operates a digital platform for residential real estate in the United States. So, by the way, a key thing, like it's not commercial real estate, which I think, that market is probably kind of sour. The commercial real estate market, I think, is a lot more sour than residential. So this one's residential. All right, so this only has monthly options. So let's go look at Open now. I'm just gonna like change this Tiger window or Tigger or whatever. And again, this came from the most active screen on the day that it broke out. With 4 days to go, let's see here. We're at the money at 35. These options are pretty darn expensive right now. So similar thing. I'd be looking to play this one from the bullish side, though. I'd be looking for on a down day. I'd be looking, to buy the call side. I don't think I would bother with the put side on this. It's
still waiting for Tigger to go away.
All right. Yeah. So.
And it's currently trading at where is
35. It's about 35 is at the money.
There you are. And it's $1.85 by 230. Oh, the put side's more expensive, huh?
Yeah, I wouldn't even bother with the puts on this one. I would just buy the calls. I mean, it's got so much support under it right now. So, like, ideally.
It broke above resistance. I see that, but that MACD is getting stretched. That fast line.
Oh, yeah, down here? Yeah, I'm with you.
I look for things like that.
Yeah.
But it doesn't mean you can't go higher, that's for sure, especially since it broke some resistance, but go ahead with your calls.
All right. Oh, yeah, I mean, it's they're just kind of expensive. Like, I would wait for a down day and try and, like, get them cheap. And what you may have to do is a bull call spread. Like, even if it's out of the money, you could construct a bull call spread that has, like, 15-to-1 payoff or higher. And I mean, anything like that is going to qualify as like a 1-inch punch trade.
Right.
But you have to be careful with those. All right, so let's keep blasting through the list here. I think another one that only has monthly options is AI. And you and I looked at this one yesterday, and it's like, it's kind of already on the down days. Like, I don't know that it's going to rocket right out of this base. It's still kind of in the base.
Waiting for it to pull up.
Yeah, I'm just going to keep moving past this one.
Go right ahead.
Yeah, you and I talked about this one yesterday.
Yeah. Was that the one with the test for a high and then it failed it? Or was that
Yeah, exactly. It kind of like made a high at like 170, no, almost 177, and just kind of like failed and started sliding down day after day. All right, XL is next up, and that's Fleet Corp. So this one, to me, it looks like it's in a really neat base right now. It looks kind of like we talked about QS earlier. If you notice, like this thing had a huge rally earlier in late 2020, huge rally up from $10 a share to 35, and it's been basing all year, and it looks like it's getting support at the 50-day moving average, and it's right there now. So I really like this chart. It's probably just now coming up on your end.
I'm going to exit out of this and I'm going to go to my finger swing on my iPad.
Sure. Yeah. Go ahead. So XL. Let me just read off the what they're about real quick. Yeah.
You're on a daily, right?
Yeah, I was looking at it daily, I think.
Oh, okay. I see.
Yeah.
That thing looks flat.
Yeah, exactly. It's been basing all year, but it had a run from $10 to 35 late last year. So XL Fleet Corp, let me read what they do. It deploys hybrid electric solutions for the commercial and municipal vehicle market in North America. So that's a hot market. Its products include hybrid electric drive system, powertrains, and data analytics systems, measure key automotive performance indicators, such as miles per gallon and stuff like that. I don't want to read the whole thing. So yeah, I mean, this is like a strong market, and I would actually look to take a position in this more than just a 1-inch punch, but because it's monthly options expiration next week, and I think XL only has monthly options expiration. Let me check that. That's how I wrote it down, but I mean, I'm not always right about that. Come on, XL. There we go. Yeah, it only has monthly options. So, I mean, this one, like, it could be like the QS for next week. I mean, it just looks like it could be really explosive here off the 50-day moving average.
I do not use the 50-day.
Really? Well, I mean, it just depends.
I use the 21 EMA.
Yep, I use that too.
Use a 2 moving average. One is a 5. They're both simple. One is a 5 and one is an 8.
Okay, I use the 5 and 8 EMA. Very similar. I also have the 9 on there. The reason I put the 8 and the 9 is because if you can see it on my screen right now, maybe you can't, but I'll tell you. The EMA 8 says $20.13. The EMA 9 says $20.12. So I'm not actually looking at the lines really, generally. I'm looking at those values. What that's telling you is it's trending higher. You know, it's in an uptrend right now. So that's how I use that. Yeah, that's why I do that. I used to do a lot of back testing, and you know, that was an interesting phenomena that I learned from back testing. So you can.
A friend of mine, Phil Pick, he's on Twitter. He and I talk a lot. I'm trying to think of his handle. It's Phil Pick.
How do you spell it?
Hillhick.
Oh, Hillhick. Yeah. Hillhick. Yeah, I've tweeted with him a little bit, not too much, but yeah, I mean, pretty good analysis from him.
Ton of backtesting.
Cool. I wasn't quite looped in on that, so that's good to know. I used to do a lot of backtesting, and I don't do so much anymore just because of everything I learned from it. I've kind of like baked into my style.
Oh wow, nice.
Yeah, it's really fun and educational, though. I mean, I would recommend it for every trader. You know, spend time in the backtester.
Oh yeah, you gotta look left to try to figure out what's going on so it's right.
Yep. So XL, around $21. Is that the money? It looks like it's not a super liquid options market, but again, like if you could catch it on a down day next week, either that or on Thursday, but the last day before expiration, you might be able to get some really cheap calls.
Right. Yeah, I'm looking at the OI right now.
As far as like putting a position on an XL, let's talk about that before we move on. I mean, there's already so many other choices in this space that have a better liquidity in the options market. But what you could do with this one, I'm gonna like look all the way out in December, and it doesn't. The 50s are expensive, man. They're like $5. So
Their implied volatility is just much.
yeah, it is. You're right. It's 150%. So that's kind of a shame.
Yeah. Especially with the big dropping.
Yeah, no kidding. Like, and it's been basing for like all year. It hasn't gone anywhere. So people have burned up a lot of money in these options already.
I bet.
Yeah. So that one could be really tough to trade. And it also.
I would think you'd beat seller on this.
Yeah, selling the options.
Mm-hmm.
Yeah.
Like that premium.
Yeah, you could. I mean, we could play with that a little bit. You want to look at like, let's look at a March. Let's look at selling a strangle in March. How about that? It's like what are those guys? Tom and I forget his name. The guys with the cherry as their they're funny guys. Do a radio show. They have a cherry as their symbol.
Oh God, I can't think of their name.
Yeah, then it's what's that?
The guy with the newsy hat.
Yeah. I mean, they're great to listen to. Really entertaining guys. Tasty Trade. Thank you. Yeah, they love selling strangles. So this is their style. It's not so much mine, but it's cool. So let's take a look. I'm gonna look at March, which maybe they would go longer out duration. I think probably right. Well, wouldn't they be looking at selling strangles in May and closing them out by March?
Yeah, man.
All right. Well, let's try and emulate their style, okay? Because it's something I like is kind of looking through the lens of someone else's style. I'm not sure exactly how far out of the money they are looking to go with this, but I don't know if you can see my screen. But if you're on Thinkorswim, you can build the same combo, right? You're in their strategy builder.
No, I am on my iPad, so I don't have the strategy builder.
Oh, I got you.
Let me get out of my regular trading and get into my paper.
Got you. I'm just playing with this thing right now to see what I can come up with, and then once you're there, then I'll let you know what strikes I'm looking at. Let's see here. So I've got one that has a 42% probability according to the calculator. It takes $1,000 of margin and collects about $3.50 of premium.
Watch it. There we go. Okay. All right. I'm here.
All right. Yeah. So out in May, what I did is I sold the 15 put and bought the 10 put.
Okay.
And then I sold the 25 call and then bought the 35 call.
All right.
Yeah.
I'll go ahead and
I mean, the bid-ask spreads are so wide on this. It's. I'd probably rather be selling strangles on something that has like a tighter options market. Because the problem is you're not going to be able to get out of it if you want to early very easily. But it's still fun to look at.
15 and the 10 on the put side?
Yeah, I sold the 15 and bought the 10.
Okay.
Yeah, so this should make a credit spread. You should see a bid of 420 and an ask of 310.
Yep.
All right, and the margin impact is $1,000. So you got to put up $1,000 for each one of these. But I mean, the premium is decent, assuming you could get a good fill, then you're looking at maybe that may be a bad assumption. But I mean, if the price continues to stay range bound, the break even is $11.90 and $28. But I mean, I don't know that it's a good assumption that the price is going to stay under 28. Although there is a big resistance at 35, it may go up and hit that resistance and come back down. So
Let me look at it on the 4 hour real quick.
yeah, you might take some heat on this trade. But then
we can stay below 28 because 28.85 or 28.50 is the 4 hour resistance. There's a lot of congestion right there.
got you.
So
Okay.
it might wick it. If it goes up, it might wick it and then just
Yeah.
hover right there.
You know, we should look at credit spreads on GameStop too, because I mean, it's a few of those other hot stocks that right now that just have like crazy high implied volatility.
Oh god, that thing's almost all the way down to where it was.
So I'm going to read off the other one on my list I had was MVIS on my monthly options list. Yeah, just for people to know. So MVIS, I'll bring up the chart now. We can hit that one real quick.
Oh, Microvision. Okay.
Yeah, Microvision. So this one only has monthly options, and it looks like it's in a really strong uptrend. So I think, yeah. I mean, by my definition of overbought with an RSI daily above 80 and weekly RSI above 80 and the 50-day moving average, it's like almost 3 times as high. It's overbought by those metrics. It doesn't mean that it can't stay up here though. So yeah, this one was big in the news earlier. What? Let's see here. What for? Scanning technology. Is this for laser stuff for self-driving cars? Yeah, LiDAR. It's a LiDAR thing. That's what it is. Yeah, you know, I don't like this whole thing about people trying to make self-driving cars with just cameras. In my view, you should be incorporating every kind of sensor that you can cost effectively do. For example, like, you know, using audio cues, humans can help avoid accidents. Well, don't you think that like having microphones could help self-driving cars also avoid accidents? Like, you know, you should be using every sensor you can to help avoid accidents. So I think LiDAR is a good thing. Yeah, but I think they're using light to do it. But I think that might be the idea. Yeah, because I think what they do is they measure, like, I'm not exactly sure how they do it, but I think they can use laser to do the same thing like echolocation.
Gotcha. Yeah, I'm a 1970s. Let me get under the hood and have a six pack.
Yeah.
Six pack and shooting. I'm good.
Awesome. All right. Well, hey, let's.
Are you long or short? Or are you bull or bear on Microvision?
On Microvision? I mean, it looks like it's in the middle of a leg up. It looks like, I mean, they just had some news-based or earnings-based gap up that, you know, is probably going to run. I think it may pull back to a trend line, but I don't think it's going to pull back all the way to the 21-day EMA.
I don't have any of those on, but I am looking at a pullback to the gap.
Okay.
Which is 16.
Yeah. I mean, that's a decent sized drop. I don't have a position in Microvision either, by the way.
Neither do I, but I'm just saying if it were to do that, I would assume that 16, you know, a good gap fill would take care of it.
Yeah.
And then run even higher. So if you do the March and do the put, oh wow, those are expensive. 236? Jesus, the idea is insane.
Yeah. Yeah, and if it had a more liquid options market, then you could actually probably use tighter strikes on the credit spreads.
Right.
So speaking of that, let's look at GameStop. Can we look at GameStop now?
Yeah.
It's like everyone's talking about it. I mean, this to me, like, it's found a floor, man. I mean, it's on what line is that? It's on the 50-day moving average, but I mean this chart looks bizarre. And the fact that it's not selling down lower, I mean, you could almost kind of put on like a Hail Mary on this thing. And what you can do is you can maybe use a credit spread to finance some out of the money calls. That might be interesting. Let's look at that. So let me bring up the GME options chain here. Yeah, GME. I can't believe how stable this is at 50. I mean, all these tight closes, that's really bullish, by the way.
I am looking at a product volatility of 100%, which is the lowest there is for April 1st.
Okay.
Which is 45
for
days.
April. Oh man, I don't want to buy anything that long out on this. What about let's look at this. Look at February 26th, and what I want to do is use a back spread to fund buying out of the money calls. And let's see if we can make anything here look interesting.
Okay.
So let's sell a 45 strike. Buy a 53 strike. So at this point,
it's on the 45 and we buy on the 53.
Yeah, so you've got $800 of margin put up right now. And now what you can do is you've got a credit of, depending on where you fill,
of about $4.
Yeah, of about $4. That's right. What does $4 get us? A 73 strike for $4.20. Holy cow. Okay. Yeah, boy, these are expensive. But you know what, though? We can get a bull call spread for $4. So let's look at doing that. Like if we instead of buy just a YOLO call out there with our credit, if instead we do a bull call spread, so let's buy a 60, and now we need to sell one for $2.50. Okay, so let's sell a 90. Buy a 60, sell a 90.
Well, I gotta open up my options.
Okay.
No, go to all. Okay. And you're on the call side, right?
Yeah, I'm on the call side.
Alright, so you're buying 60 for 640,
Yeah.
probably around 580 for that. Thereabout. And then the 90. There's 315, 252, so you're probably looking at $3, $2.90.
Yeah, exactly. So, by the way, like if you could get good fills on this, you can actually get it filled as a credit, and that would be ideal. Like I wouldn't bid this up to the ask. It may be that we can give ourselves a better chance by changing just slightly some of the options that we are.
Well, we're coming off a 3-day weekend. What's
Yeah. Right. So I mean, it's 9 days to go. You're not going to want to hold this for all that long. And the other thing I'll point out is it takes $800 of margin to get this thing, and the max profit that you can make is $2,000. Well, I mean the max the position can be worth is $2,000.
Right.
It looks like your max loss is $1,000 though.
Oh, that's a good deal.
But that happens. Hang on. The max loss happens if you buy it as a credit. Or I'm sorry, if you buy it as a debit. If you buy it as a debit for $213 and you add that to the margin impact of $800, that's how it gets $1,000. I would not buy this as a debit. I would only get into this as a credit. And ideally, if GameStop had a down day, you might be able to get it for less margin. You might be able to get it for like $500 of margin for pretty much the same trade. And then you're looking at, you can make a four bagger on your margin. You know, if you posted 500 and it actually makes the full value of $2,000, you know, then it's, well, I guess for you, you've made 300%.
What's your DE on the underlying? Your break even?
Oh, so that's a good point. Like if you put it on as a credit, anything below 50 at expiration is anything below 45. So if the price falls at all at expiration, if it falls below 45, then you get to keep your credit. Basically, you walk away with like, you know, $50 in your pocket or whatever the credit was, right?
Right.
That's why I like doing it like this, because if you just buy the straight up bull call spread, you're gonna be posting 640 minus 252. I mean, you're gonna be posting like $300 or $400, right?
Right.
And with this one, yeah, you're posting a margin, but it's really not at risk if you don't sit in the trade until expiration. Like if the price starts moving, you're gonna either like move into a profit quick, or you're gonna move into a loss quick on the underlying. So again, if it closes below 45, then you know you've got a credit. So it's got some protection there. There's less money at risk, assuming that it's liquid and you can close it all out, than if you just straight up buy that bull call spread. I mean, these options are so expensive though. Like I've got a position on similar to this in Nvidia right now that is like dirt cheap by comparison, and like it stands to make so much more money that it's crazy. So, all right. Well, anyway,
I didn't even look at Nvidia's implied volatility on there.
yeah, it's pretty low. It's like 55 right now or something. But hang on, before we jump on that, let's get rid of that bull call spread, and let's look at doing a strangle on this thing. So I'm just going to clear all the legs, and let's look at a strangle with 11 days to go.
All right.
So let's.
So I can probably go to 25 strike on my chain. All right.
Yeah, so it's at 53. Let's look at the ATR here. The ATR actually is meaningless. It's like 51. So forget about that. It's the share price for the daily ATR. That's insane. Okay, so starting with a put spread, what do you think? Like sell a 40, buy a 35? No, that's like nothing, man.
Right.
What would you do? I don't even want to put words in your mouth.
No, you're not. Sell a 45 and buy a 41. What would that look like?
Well, the 40 is so much more liquid that, well, I mean, the 41's pretty liquid too. All right, let's go to that. All right. So that gives you, if you could fill near the midpoint, you'd be looking at $1.75 credit, and your margin's 400, so pretty good. But let's put one on the call side too, because the nice thing is, you know, unless you get whipsawed and you leg out exactly wrong, like if you put one on the call side, it's also 4 points apart, doesn't even cost you any more margin.
On the call side, I want to be below 56 and a half. And that would be pushing it. So it would be sell the 58.
Well, it's 53 right now, yeah. So, okay, so sell the 58. Go ahead.
And buy, let me look at the call. Trying to buy the 48. What would that look like?
48. No, you're not doing that.
No, I'm sorry. Wait.
Try the 62. Sell the 58 and buy the 62. Try that.
Sell 58 and buy 62.
Yeah. Profit probability 26%.
Sell 58 and buy a 62.
Yeah, I mean the problem is like I take a bullish look on this
I don't know if there's
chart.
enough in there.
Yeah, I don't think so. I think you're right.
I don't like that call side.
Yeah, I think the put side's where it's at. So
Yeah, definitely.
I mean,
Sorry, I'm working off an iPad, so I have a limited resources here. I'm trying to do it in my head because I'm looking at the chart and the
yeah,
strength.
all good. So let's talk about this for a minute. Just the put side of this. Um, if the stock takes a dip, then this credit gets bigger, right? Am I saying that right?
What did we do on the put side?
We sold a 45 and bought a 41.
Okay, sold the 45, bought a 41. So we need to stay.
Well, above 45, yeah. Your break even is around $44 is the break even. I mean, I think if you could get this for $2.
I'm on the phone. Wait, I'm on the phone. Sorry.
Oh, good.
Someone just came flying in here talking about what he just did.
I think if you can get this for $2, it might be kind of good, but
I don't like that call side. I like the put side.
yeah, the put side seems good. All right, well, what other things can we do to spice this up? Like,
In game?
yeah, if we're gonna buy this, or if we're gonna sell that credit spread, man, I sure do like to like get a call or something. I mean, I don't know. Maybe not. These calls are like crazy expensive, dude.
Yeah, they are.
All right, what about if you bought 100 and then you sold 150? Look at that.
Bought 100 and then sold the 150.
Yeah, because you can get that. That's like 50 cents of your credit, right? Is it 50 cents? No, it's more than that. That burns up your credit, actually.
I think that's going to be too far out.
Yeah, that burns up your credit, and but it's got 2 weeks to go. I don't know that I'm crazy about
I
that.
don't even think it's going to get to. What was that? Hold on a second. Give me 1 second here.
Yeah, but I mean, the problem with bull call spreads is like if this thing runs, like there may be no limit to it. So why cap it, right?
I don't think it's going to run. To be honest with you, I think it's done. It looks dead.
It looks dead at 50.
Yeah, do the 108.
Well, I mean, you could actually what you could do then is you could sell the 100 and buy the 150, but that's going to take a crap load of margin.
Yeah, you'd be better off buying 100 and selling what did I just say? The 110 or the 100? Sorry, I'm trying to get back from the options. Yeah, you can make an extra $1 per share by buying 100 and selling the 100 strike.
You mean buy the 110 and call and sell the 100 call?
Buy 100 shares and then sell the 100 strike. Like a covered
like a covered call.
Mm-hmm.
Yeah, interesting.
And then your margin shouldn't be affected.
Yeah, that's pretty interesting. If it falls, you lose on the put spread and the shares, but you make a little from the call.
It would need to keep going sideways.
Yeah.
Which is what I think it's going to do. I honestly don't see any catalyst for gain.
Yeah, but for 2 weeks though, I don't know, man.
Do you know of anything that could possibly do anything to it that would make it that volatile? What's the weekly change is -3. The implied volatility, well, I'm not worried about that. That's why we're selling.
Well, I mean, if you zoom in, like to me, that looks like if you zoom way in, it looks kind of bullish. Yeah, like look at 5-minute bars. It ended on a positive note on Friday. It had nice volume, and it cleared above like kind of an intraday resistance level.
Yeah, but I mean, even if it gets to 70, you know, you're still good on the call at 100. I mean, it's really got to get going.
Yeah, well, I mean, if it gets to 70, that's like ideal for the trade that you put out, because your call's going to expire worthless that you sold, and that put spread that the credit spread for the puts, you're going to collect that premium too.
Right,
so
because you're looking at good resistance right there.
Yeah, at 55.
At 73-ish.
73.
Yeah, if you put a line straight across at 73.5, you'll see you have a support and resistance line right there.
Yep, I see what you're talking about. Yeah, you're right. That is a major resistance. Well, should you then sell the 80 instead, or is that too close?
I think that's too close. I think you tapped in feet.
Yeah.
All you need is a wick and an exercise, and
yeah,
that screws up your whole plan.
Yeah, you're right. Yep, shares called away. Well, yeah, interesting. That's an interesting strategy. A covered call with a put spread. I like that.
It's just, something I see, because the call side was just it wasn't giving anything away.
Yeah. Yeah, but they're like too hard to buy those calls too. So, all right, well, that's pretty interesting. I mean, I think maybe there's some 1-inch punch trade on the overnight thing opportunity there too, right? Maybe with like bull call spreads that are wide, or else just with outrights. I'm not sure. It just depends on how much time till expiration. Oh man, I have such a huge list. Let me take a look.
Do you like trading Amex?
Amex stocks?
American Express.
Oh, what's the symbol? I don't even know it.
AXP.
AXP. I should have known that. That's in the Dow, right?
I don't know.
I think it is, or it used to be.
I have 1, 2, 3. I have 7 support and resistance lines across this thing, and it hits every single one.
Oh, and then it turns around.
Well, it doesn't necessarily turn around, but it just take a gander at the American Express on the daily, and you'll see.
Yeah, I'm seeing it.
It's expensive though.
It's like it hits a Bollinger Band and taps out. It's like that's interesting. Have you looked at this as a ratio chart with any of the other credit cards, like Discover? What's Discover's symbol? I forget.
I have no idea.
Ah, dang it. All right. Discover Financial.
I could just...
Well, let's look at it. Forget Discover. Let's look at it with Visa.
Discover is DFS.
DFS. Okay. Yeah, so it looks like AXP is kind of like been underperforming Discover. That's all where I was trying to go with this. Like, is it outperforming Discover or underperforming Discover? It looks like American Express is underperforming Discover. The reason I wanted to call that out is because, like, with those oscillating things, sometimes there's like a pair trade thing you can do as a value. But let's stack it against Visa. Now, it tracks Visa a lot closer. Yeah, that's interesting. It looks like American Express is on an upswing relative to Visa right now. So where I'm going with this is when American Express goes and hits one of those resistance lines that you have, you might look at, if you've got an American Express position, rotate it to Visa instead of just going to cash. Maybe. Might be an idea. I mean, I don't know.
Visa and MasterCard track.
Yeah.
American Express is really it's not the same. If you look at it.
Yeah, you're right. When I look at Visa and MasterCard, they track.
redemption on MasterCard for a week or two, like maybe a week and a half.
Yeah.
And it's not gonna reverse on you in some stupid way.
Yeah. These two look like great pairs trade partners, Visa and MasterCard. I don't know about, I guess AXP probably less so. The AXP is, I think that's in the Dow. All right. So anyway, yeah. Talk to me about it. What's the game plan for next week?
American Express is at a trend line resistance and a resistance period, support and resistance line. It still looks like it wants to go higher. It doesn't want to break through, but if it does, it might wick and then reverse. That's what I'm looking at. It's getting toppy, and I would want to hold this. I would wait, actually, probably put a limit. Let me open up my options chain here.
So would you get like a 1 month out put or something that's out of the money? Or
no, I wouldn't need to go that far. I would do a 3 week, maybe a 2 week, but I would have a limit.
Okay.
So let's do the 5 March.
It looks like you use the 21-day moving average for your strike price too.
I don't have that set up.
Okay, well I'll tell you where it is right now. It's 124.
The 21 day?
Yeah. So it looks like when it hits resistance, it looks like the 21 day looks like it's out of the money, but it's not so out of the money that it doesn't get like crossed through within a few weeks.
The next SR that I have for it is 122.5. So 122, I guess, would be a good one.
All right. Well, let's look at puts. So ideally, like it has an up day early next week, and then reverses and closes the week lower, right? That would be ideal. And so, like, we would want to probably capitalize on any up day above 130 to buy a put at like 125 or 124 or something like that. So let's take a look at that. I'm going to put in AXP here. And you said 3 weeks to go on the calendar. So
you look at the money, say 465, but you're gonna want to do it. Let me look at the theta. The theta is 8 cents. So for 24.
So yeah, that's a good way to do it. You could buy an at the money put and then close it out like near that 21-day moving average. Maybe that might be a good way to do it.
Right, but I'm trying to figure out my limit. So my limit would be $4, maybe 375. I'd probably get 385. Because whenever I say 375, I always add 10 cents because it never makes it. And then I get pissed off and I throw shit.
So wait. When you say 375, you're talking about 375 for what?
The 129 put.
The 129 put for March 5th?
For March 12th.
March 12th. Okay, yeah. I was on the wrong calendar. That's why. Okay. Yeah, I got you. All right, so that's a good way to do it. Like you could basically put a bid there on it, and if it comes down to your bid, then you're it probably did that because the price went up for AXP.
Right, that's what I'm expecting.
Yeah.
Like a wake up to touch my truly touch my trend line. And you could always set I don't know if you can do this with cheap trade. You could set a limit on your ask. So that if it gets at or above, or you can do above, I would do an at or above $4, so you can keep an eye on it and see what the price is doing while you're busy looking at other stuff and you don't forget about it.
Yeah, because you wouldn't want to leave that bid in for more than like a day or two.
Right.
So
I always have that safety measure of ding ding ding, hey dummy, look at me.
Yeah.
You know?
So there's like if we buy that 129 for what I don't know.
Say it gets over at 385.
Yeah. So at expiration, you would need it to be below 124, right? Or no, 120.
123 and a half probably.
In order to have profits on it, right? At expiration.
Right.
I mean, probably you wouldn't want to hold this until expiration, ideally.
Oh,
Yeah. Yeah, like if you see a big profit, then take it, kind of thing.
Oh yeah, if it drops, yeah, take a look at that.
Yeah, cool.
And then watch it.
All right, well that's a fun play.
That's what I like to do. Those are the 1-inch punches that you're talking about.
Well, that's slightly different. That's more like a karate chop. The reason I say that is like, you've got to post up like $300 per contract there, and if the price continues higher, like, that's going to burn up fast. So that's what I mean by motion. Like it's you're burning up some motion if it goes against you.
Well, where's the gamma? The gamma is 3. I don't know that it'll eat up so much. The IV, the applied volatility, and the.
Well, I'll tell you this: the upper Bollinger Band's at 133 right now, and this thing does not survive long above the upper Bollinger Band. So.
Let me throw the squeeze on it. Do you ever use John Carter's squeeze?
No,
Alright, I'm looking at the Bollinger Band on the daily, and it's above the 132.5. You think it'll get there?
Yeah. I mean, I don't know. It's gotten above it in the past, but I mean, the bands are wide right now. That's the thing. When the bands are wide, it never really seems to hold above it. It doesn't mean it's necessarily going to drop a lot, but I guess what you could do is you could do it in 2 phases. You could leg in now around that 130, trying to get into the 129 put, and then if it does go up and get above that 130 or around that 133 Bollinger Band, you could do a second leg on the trade. And part of that might just be like making, the wins from that, making back some of the money that you lost in the first one. But, yeah, so that's another way to do it, is do it in 2 phases. Just have a plan for either scenario, right? One where it gets to around 130 and reverses, and another one where it continues higher. What are you going to do? And I mean, I don't know that I would keep on swinging at it like that. I mean, it's, you take your shot and maybe 2 shots, and if it doesn't, if you're not connecting on those, then it's maybe kind of on to the next trade.
So here's another interesting one for you, and then I'll let you go back to your watch list. So the yields are high right now, right? The rates are high.
On what? I mean, they're low on high yield. They're high on investment grade government sovereign bonds.
HYG, for example.
Okay, HYG. Yeah. Okay.
That's not my play.
So yeah, I get what you're saying. Like the share price is like crazy high on this. Yeah, this is a great one to talk about.
So I have noticed that when the HYG is starting to pop up, IYR, which is
the real estate ETF. Yeah.
It's a what do you call those things?
Yeah, so the yield curve is wide. I was talking about this earlier on the broadcast, probably before you were watching. We were talking about REM, and we were talking about XLF, right? And so this is like a hybrid between the two, because IYR is a real estate ETF, but this is companies that actually own real estate and like rent it out. I think they do have some mortgage REITs in there. But it's not a mortgage REIT and it's not a bank. It's like, it's something else.
Yeah. So. I play it like you though. So my thing is that when the HYG starts getting up there, IYR doesn't like it.
Yeah.
And that's what I've seen in the past. So I didn't know if you wanted to take a look at IYR and give me your input on what you see on IYR.
Yeah, I mean, to me, this looks like it's just going to continue to drift higher. I don't necessarily see that it's going to be vulnerable to a whole lot of shocks, other than I think the negative impact on commercial real estate is probably already been sorted out on this, and the yield curve being wide it does help it because the folks operating these companies may try to take advantage of the yield curve being wide. That's something that they can do because they can borrow at those short rates and and take advantage of it. But because they'll borrow at short rates real cheap. Think about like a floating rate mortgage. If you got what do they call it, an ARM loan, adjustable rate mortgage.
Oh, yeah, restricted rates.
Yeah, that's an option that these real estate holders can do. They can refinance their properties into ARM loans, and if the rates, if short rates, they can push the durations real low, and they can use ARMs and things like that. I mean, they don't want to use ARMs at long duration, but they can push into the short duration and they can use ARMs. If you're borrowing it long term on an ARM, then this is probably not a good time to do that. But anyway, the point is, like, they have all these tools for borrowing, and so when the yield curve is really wide, like it is right now, that they can take advantage of that. And so I don't know that I necessarily have a negative view here, but I mean, with HYG, you're right. I mean, this thing, I don't see how much higher it can go other than just like, I mean, this is probably starting to get to a really good pair trade situation where with TLT, yeah, you and I touched on this yesterday near the end of the show, but I think there's a number of ways to do this. I've looked into it. One way you can do it is you can buy you can buy a option spread. Like in this case, you would get a bear put spread on HYG that's not out of the money and it's not in the money, but it's instead it sort of wraps around the price on both sides. It's got a really low time decay. Another thing we could do is we could do synthetic stock position in HYG, but in reverse, so in synthetic short stock. I'm going to throw that up on the combo real quick. So you could go short HYG using synthetic stock and long TLT using synthetic stock, or you may not even want to be long TLT, but the idea here is if the stock market crashes, it might be a really cheap way to take advantage of that. Because crashing the stock market is one way that they can push the yields on long-term treasuries back down. If the bond market starts to run away on the long end, then we talked about the government can buy those securities and help push the yields back down, which raises the price on TLT back up. If they feel like TLT is crashing. The other thing they could do is they could like essentially tip over the stock market, and what that'll do is that'll essentially force a lot of pension funds and things like that out of stocks and into the long-term government bonds, or even into short-term government bonds. And whoever was in short-term government bonds is pushing out into long-term government bonds. They're all pushing each other around on these options, or on these yield curves. So let me get up. Let's look at a synthetic stock for HYG and just see how cheap that position can be put on. A short position in HYG using synthetic stock. So I'm going to go into Strategy Builder. You're going to be lagged a little bit, but I'm calling it out as I'm doing it. Maybe you can build it on your side too. So it's 88 is at the money. So what we would do is we would buy an 88. Oh, yeah, good call. Time frame. Let's go to April expiration. April monthly. So April 16th. We're gonna buy an 88 put and sell an 88 call. That is a synthetic short position. And the margin requirement for this is only $1,800. And like, here's what's amazing about that is if you were going to and it takes a credit too, a small credit to put this on.
Buy and short the same strike on the call side.
No, we're buying the 88 put and selling the 88 call.
Oh,
Yeah, and you should see like at expiration, it's like this, essentially like a diagonal line.
Right. Okay, so buying the 80 call.
No. We're selling the 88 call and we're buying the 88 put.
Okay, so we get that down to 100.
Oh my God! Look at the curve evaporate above 90 on this. Look at that, dude. Anything above 89 strike, those options are worthless on those calls. The market's essentially saying like this thing cannot go higher. That's why it's so cheap. I mean, remember they're paying out dividends too. It helps keep the share price suppressed.
Okay, yeah, I see what you're saying.
Yeah, this is nuts. This is like a really great thing for us to be uncovering here, discovering on this research, market research, trading homework. I'm trying to take that negative connotation from homework and turning it around and making it a positive thing. All right, so anyway, if you were to buy this on margin, for example, at $88, you're talking about for 100 shares, you got to post up $4,400. Or if you want to short it on 2-to-1 margin, it's $4,400. But look at this, you could get this for less than half that price. This synthetic short. So the point is, like, you could short the crap out of this. And what are the odds of HYG going any higher? I mean, look, it hasn't gone anywhere since December hardly. I mean, say it moves up a point or two. Well, I'm looking at it on the simulator. If it goes up to 92, we'll have lost, $500, a third of the money we put down. But here's the flip side. Like, say HYG, if the market really has a shakeout and high yield gets spanked, it may fall down to like, say, 75. Well, what does that look like? At 70, this is making 100% return. So, and the other thing about it is you'd have to roll this, if you wanted to keep that short position going. So synthetic short is one way to play this, and it's cheaper and better, I think, than shorting HYG itself. But say that we want to do there are other things you could do. You could do a calendar spread that's bearish. You can also do a bear put spread. You could do a diagonal. I mean, there are a lot of ways to do this. So, I mean, this is part of what I'm trying to do on this show that I feel like isn't really covered very well everywhere else. Is if you hold a view, what is the best way to express that view? Yeah, and so I mean the odds of the high yield market falling apart in just a month or two is pretty low, but cracking open that hard, it's very low odds of that happening. But it may be so cheap that just rolling a bearish trade is no big deal to do. Like,
I'm sorry, my house is starting to get really loud.
Yeah, that's cool.
Let me jump off here because I don't want to screw up your.
Oh, yeah, that's fine. I'll tell you what. I mean, let's just do one last thing and then I'll end the stream. Just look at an 85 put just by itself.
85 put, okay.
Yeah, it's 55 cents ask for $57. Look at the coverage you're getting, and this is April, all the way out to April. If this thing has a big drop, like it's pretty good.
Let's show 85. So we're talking about selling it?
No, buying that 85 put. So this is a proxy for this is for buying protection on a portfolio. So if you've got a bunch of long stock exposure and you're worried about like the market going down, like this may be like cheap protection here. And odds are decent that this fizzles out, but like I mean it's 86. Yeah, all right, cool.
The only reason is because I have a wedge going all the way up this thing, and it's been running top of the wedge, like you said, since November.
Yeah, I mean, really, like,
come down and touch the wedge, which is currently at the 86.
got you. Like, essentially, like buying an at the money put on this thing is just dirt cheap. And the 86 is, I mean, it's real close to 87. I mean, it's so cheap to buy this thing. In fact, I'm looking at the 87 put right now. That's a 31% profit probability for April. So
I'm looking at the OI and trying to see where the market is, and it looks to be very bullish.
yeah, so I mean, what if we do something like sell a 90, buy an 89, and where does that put us? I'm essentially trying to finance the trade. Because then what you could do is you could buy that 86 with the credit that you've got. Yeah, take a look at that. So sell a 90. Yep, 305. Buy an 89, and what that does is it keeps your margin to $100. Okay, and then
on the put side.
yeah, on the put side, we're selling a 90 put, buying an 89 put, and then buying an 86 put, and you'll find that that's a slight credit. Yeah, it's a slight credit to do it that way. This is a back spread, so the point to do it this way, the reason to do it this way, Chris, is like look at what happens if it does in fact go higher. You know, if HYG goes higher, then you don't really lose. You only lose if it closes in a range of 85 to 89 or 85 to 90. If you hold it till expiration. But with this, there's so much time left that you can roll it. So you know, this may be the way to do it. And if this market goes down without stopping, this is open-ended. You know, like you can make money even at a 30% drop. You're still making more. And so, you know, if you think that the credit world is about to implode, this is a fantastic way to play it. It looks like to me. And you can roll this, and what I sometimes do is look at like how far out do the weekly expirations go, and just keep it at the furthest out weekly, and just roll that every week. And if the market is liquid enough, you can do that, and it costs you almost nothing. Because the time decay with 5 or 6 or 7 weeks to go is very low.
I'm sorry, I was just looking at the dollar. Yeah.
Yeah, so this is something we want to keep an eye on. Let's revisit this next time that we're doing this broadcast together.
Oh, cool. I would like to, if nothing else, go over these trades on Twitter.
Yeah, we should.
Because I'm kind of out of pocket right now. Because like I said, I'm on my iPad. So.
Yeah, I got you. All right, well, why don't we go ahead and end the stream here? I've been beaming this out for a long time. I did a longer than normal one today because the markets were closed, and so I got started earlier in the afternoon.
Oh, cool.
Yeah, because what I usually do is I wait till after 7 p.m. Central, because after market is done, and so like there's no more price changes happening in IB because. I don't want price changes happening on this. Like this is, and sometimes I trade after hours. And like I'm not trying to do my homework while the markets are moving. If that makes sense.
Right.
Yeah.
So you trade after market?
Sometimes I trade after hours. Like with GameStop was going nuts during after hours, for example. Also, like whenever a market's broken. There's a lot of action in after hours and pre-market. So another example is in the March crash from last year. I was in there buying in after hours almost every day, those mortgage REITs and the MLPs, the Master Limited Partnerships. Mostly, when things would break like crazy in after hours, I would go in there and scoop all that crap up. So
did that work?
Oh man, like it was just insane. Yeah. Yeah. In fact, next time I'll tell you some stories about that because learning about what happens in a full blown panic can help you be on your feet and making the right moves on the next panic. And so, like, I got to get your stories about it too because you were actively trading at that time. So that would be a really fun topic for us to cover.
All I did was buy puts and let them ride. Every week, let's start anew.
Yeah.
And then I'd wait for the rip to come to maybe a 23% ship, and then start scaling into another put.
Yeah, well, you may have done even better than me on the way down. I mean, on the way down, I was mostly hedging with VXX, just VXX shares. I was hedging a margin portfolio, which the move accelerated so fast it was almost impossible even to do that. Like, that's kind of what pushed me into trading options. I wasn't trading options at that time, but when I tried to hedge everything that I had using just VXX, which had been adequate up to that point, it was inadequate. And so I realized, like, okay, well, probably time to like make the move into options. So, I've been studying them ever since. And so, I don't have as deep of experience with options, but I'm pretty creative with it and I'm a fast learner. And so, a lot of the things I'm doing, I'm not seeing other people doing. And so, either that means I'm doing something wrong, or I just have a style that, maybe could use a little bit more coverage out there on the internet because a lot of people aren't really talking about back spreads and ratio spreads and some of these other things like the swoosh and things like that. Position trading.
I've never heard swoosh, and that's really interesting to me. And I want to get to learn that more.
Yeah, thanks. Well, it's what I essentially did is adapted my position trading tactics to into options combos. That you have to actively manage them. However, like they serve the purpose of the position trading I was doing even more elegantly than when I was doing it just with shares. So, shares with stop losses or just mental stops and that kind of thing, like cutting loss or average scaling in, scaling out, that kind of thing. Like, the swoosh just does it better. So, and there are a few variants too. So that's the main one. But hey, I know that you got to go, and thanks for coming on again, Chris. It's been fun.
It was a pleasure.
Yeah. All right. Well,
So to the wife and the cat.
all right. Yeah, we'll do. Yeah. Adios. I'll catch you maybe tomorrow. We'll see.
All right, John. Have a good one.
All right. You too. See ya. All right. Hey, with that, I'm gonna end the stream. If people want to follow Chris on Twitter, it's Sell the Fucking Rip Trader or at STFR Trader. And then I'm at JONTAIT on Twitter, at Jon Tait. If the video was awesome, hit the like button. Thanks, and we'll catch you guys again soon. Adios.
Bye. Yeah. Bye.
Bye.